Anand, hi, afternoon. Great to have you on the show. Anand, just want to pick up on the point on IT firstly, because it seems that all the good work done post TCS's numbers is getting undone today. What is your own sense on whether or not any of the select few IT names also merit a buy?
You could argue that tactically, because of the fact that the stocks have corrected quite a lot, there may be a reason to be looking at that sector. But if you look at the business, I don't see any reason for optimism just yet. Frankly, the competition just keeps increasing because most of the makers of AI today are looking at getting into the services field. At the end of the day, the deployment of forward deployed engineers is nothing but an IT services opportunity that they are looking to pursue. And they have a clear advantage over the fact that you are also the maker of the fundamental models. So therefore, you can not only help the client companies to set up their own AI processes, but more importantly, tweak the models, something which the Indian IT companies will find it difficult to do. On the other hand, you also have the valuation. While they may be looking cheap in comparison to what they were in the past, don't forget that even a mid-sized company like Persistent today, for example, trades at something like 5 times sales. A company like Accenture, which is largely based on business understanding and processes, and a little less on technology, perhaps in terms of outsourcing, is actually trading at just about 1 time sales or a little, perhaps just about a little more, and has similar growth prospects like some of the mid-cap IT companies. So even if you were to look at IT services at all, why would you not look at an Accenture as opposed to the Indian services? So net, if you are an India-only investor, certainly you might want to have one name in your portfolio, but I don't see a compelling reason to be anywhere close to even equal weight on it.
Okay, all right. Let me, in fact, go across HCL Tech CEO and MD Vijay Kumar's statement on retaining the guidance for FY27 and the company's roadmap for AI data centers. Listening to what he had to say.
Retaining our FY27 guidance of 1 to 4% at a company level revenue growth and 1.5 to 4.5% for services, both in constant currency. Margin guidance is also retained at 17.5 to 18.5%. And for clarity, this guidance is for organic growth and does not include acquisitions, including the recently concluded the Jaspersoft acquisition.
Okay, so that's the view coming in on HCL Tech. But let me quickly go across. Kunal, what's your view with regard to this 4.5% gash on HCL Tech? Do you go out, go long?
So not immediately, but I think, maybe I think over the next couple of days, there could be a better opportunity which could arise for HCL Tech. The 20-day moving average support for, or the level for the stock is at 1130. The stock is currently at 1165 approximately. So which means we'll wait for potentially either a time-wise or a price-wise retracement towards this 20-day moving average. If that happens, say in the next 2 or 3 days, then maybe I think closer to this 1130, 1140 range could be a better price points to go for a contrabuy in HCL Tech.
Okay, and what's the take, Kunal, with regard to TCS in particular? Because that one is bucking the trend.
Yeah, it is, and the stock has been a lot more stable. Post the results for TCS, the stock post results, I think on a single day had seen a very mild uptick, but then the following next 2 days, the stock has seen a decent upside. Net, I think it's moved on from that 2000-ish kind of a zone, which it had hit, I think, a couple of weeks back towards 2200 mark. TCS is a large cap stock, we all know that, but more importantly, it's a very low beta name from the entire IT gamut. So you expect that the stock would go into a very slow, gradual uptick. But the fact that it maintains the positivity indicates that we are looking at a potential possibility of a decent trend in the making for TCS.
Okay, let me in fact go across to Avi. Landmark Cars is the one stock which is on the tear on the back of what was a very strong business update for Q1 FY27. Avi here decoding some of those numbers.
Landmark Cars has come out with its Q1 business update and the auto sector clearly has been heating up. The vehicle sales are up by 24% on a yearly basis and the after sales segment has also increased by 14%. This was the highest Q1 for the company, driven by strong vehicle sales as well as the after sales segment. New models were launched in the June quarter, like the Mercedes-Benz CLA, MG Magister, and the new Renault Duster. So the deliveries for which led to the growth in the business for the company. Further, new models are also expected to come in the upcoming quarters from Mercedes-Benz, BYD, MG, M&M, Honda, and Kia, which will further strengthen the business growth and traction for the company. The supply of BYD in this June quarter became better and is expected to increase in the upcoming quarters. Also, the ramp up and stabilization of newly opened workshops, the after-sales business delivered strong performance on back of this workshop expansion. The company is expanding its workshop capacity in several brands to meet the increasing capacity and demand that the company is facing. So, on a strong business update and the auto sector heating up, Landmark Cars is up by almost 15%.
Thank you for that, Avi. Anand, this has been a couple of quarters now. Landmark Cars has come back into focus in a big fashion. Sales have picked up very well. Premium cars continue to do very well. Do you play this theme? Do you avoid it? How do you play it?
And the car auto sector has been doing well even in the markets, and the numbers are there to show the kind of performance that we've seen. Would you want to play it through an agency like Landmark? I think the margins there are going to be very narrow, and of course, to the extent that volumes go up, they will also benefit. But I think it is perhaps safer to either buy the auto ancillaries or the car or the manufacturer themselves. Do keep in mind, however, that over the last 10 years, the valuations of the car manufacturers and generally the auto sector has doubled, whereas the growth has been inimical for a reasonable large part of that. I mean, it depends on the segment you're looking at. So while the high-end cars and the SUVs have done quite well on a smaller base, SUVs not so much. They've done well without and have been taking a larger part of the market share. The two-wheelers have suffered. Even today, for example, the motorcycle volumes are lower than what they were, I think, pre-COVID. So we still haven't crossed that. Those scooters have picked up. So yes, there are segments in the market, tractors being one of them, which have actually done quite well. And I think it is better to actually just simply buy the auto manufacturers or the ancillary players because they have a broader set, especially those which are also exporting. Companies like the sellers and the servicing companies are okay, but they are kind of marginal at best in terms of the kind of money that they'll make out of the ecosystem.
Okay, Kunal, this Landmark Cars move?
Yeah, it's a very strong move. Just looking at the charts, the stock is back towards its almost closer to its 2026 highs, if I'm not wrong. It started off the year at 480, 500 levels, moved lower towards 340 mark. So it was a decent correction for more than 30% for the stock price at the start. But it's managed to recuperate those losses and come back to a good uptrend. What's interesting about the chart is that the weekly time frame basis, we are looking at the indicator, the MACD coming back into a bullish territory. If that happens and if it sustains this level of 480, 500, say for the next 1 or 2 weeks, we could be looking at a potential possibility of at least another 3 to 4 weeks of a consistent upside over the short term. That could take the stock towards almost 500 to 550 range in the near term. So which means potentially another 10% could be in the offing for the stock.
Another 10% in the offing. So that's the trade on Landmark. Also curious to quickly pull out some buzzers as well in trade today. And within that pack, there's also Fino Payments. That stock is up 9% in trade. Kunal, I'm sure you don't track it, but if you can give us a sense, it's been a couple of days where there's been very sharp moves on this stock. What next?
So I think we are in that phase of the market where many of these beaten down names are going through a major short covering wave for themselves. Even Fino Payment Banks, for example, the highs when the stock started off in 2021-22 was almost at, I think, 500, 550 mark. From there, it's been a consistent pattern of lower highs and lower lows on the quarterly charts. The stock recently made a low, which was around 120, 130 for the stock in the last, I think, 3-4 months back. And now it's moved towards 175 kind of a mark. So I think it's been into a recovery phase for the stock. But, when you look at this on the long-term charts, it still looks like the long-term trend for the stock is still on the downside.
Okay, long-term trend on the downside. Be careful there, viewers. That's what Kunal seems to be kind of putting out. Let me go across to Mithali. She's here with HDFC Life. They're set to announce the Q1 results tomorrow. Analysts penciling in slower premium growth and a marginal decline in profitability as well. Mithali is here with what to expect.
Right, talking about HDFC Life, so the company is expected to report a moderate set of numbers for the Q1 FY27 with growth seen moderately in their new business performance, while margins could be under pressure for this quarter. The annual premium equivalent, or the APE, it is expected to grow nearly 8% on a yearly basis, while it could see a decline of nearly 33% on a sequential basis due to the March being a seasonally strong quarter. The growth momentum, it remained weak also during the quarter, with April and May being a slowdown month for the company, while a flat growth seen for the month of June. The value of new business, or the VNB, it is which is a key measure for the profitability of the new business insurance companies, it is expected to grow nearly 5% yearly, while the VNB margins are expected to be under pressure, reported at 24.3%, which will be down nearly 80 basis points if you see on a yearly basis. The margin pressure, it is expected to come from the GST input tax credit losses, partly cushioned by the favorable product mix, if any. The key focus for the investors will be the management commentary on APE growth, the trajectory of the VNB margins, commentary on the product mix, and also if any restructuring seen on the recapping or of the commission payouts. The key takeaway is that the HDFC Life, the results could deliver positive growth in both the business sales as well as the profitability front, but the pace of growth, it remains modest, and margin pressure, that is one concern the streets are penciling in for this quarter for HDFC Life.
Okay, thank you so much for that, Mithali. Let me go across to Anand. Anand, some of these names within the life insurance pack, quite beaten, don't you reckon? And would you say that it's a good time to probably go out and buy? I mean, when we try and compare some of the price to book ratios of large cap private sector banks and then their peers, which are life insurance companies, the re-rating has been quite solid.
Life insurance went through a bit of a hiccup for some quarters last year, but after that, I think the numbers are beginning to show up again. Frankly, companies like Max Life, for example, have done exceedingly well. And SBI Life, for example, continues to deliver a steady set of numbers. HDFC, ICICI have been a little more patchy, but net, looking beyond the quarter, there is no question that life insurance still remains somewhat underpenetrated, if not in terms of number of policies sold, then in terms of the value of each policy. I think India remains somewhat underinsured. The other thing is that, we still have very few risk policies opposed to ULIP policies. So I think the runway remains very large. Aside from regulatory changes, for example, where the requirement that you need to diversify or have an open structure for selling multiple policies through bank assurance, other than those kind of things which may affect some of the listed players, by and large, I think as a sector, I'm very quite bullish on this space and its ability to continue to show reasonably strong growth over many years to come. So any such fall should be looked at as an opportunity to buy. Remember that life insurance is actually for life. So, once you have bought a product from one company, you are unlikely to be able to shift, which means that even if the initial margins appear to be a little low, the lifetime margin for the policy will still be reasonably high. So I think, looking at players which are able to grow and have a good enough reputation that you are willing to stake a lifetime worth of insurance with them makes a lot of sense from a customer point of view and consequently as a shareholder as well.
Makes sense. Anand, I know you did mention that you buy on every dip. Do you buy now or do you wait?
Well, that depends on the kind of context that your portfolio is operating in and what you think overall. But I am a great believer of diversification, so you shouldn't be overweight dramatically on any one or two sectors. So given your asset allocation, I would argue that, wherever sharp falls happen, you should look at them as an opportunity to buy. It doesn't have to be at one time. You can stagger it a bit. But, trying to time the market and saying I will buy at the absolute bottom or top never happens. Therefore, it is best to start making small purchases across as the market kind of shows trend one way or the other.
Yeah, wonderful advice. Thank you. Thank you for that. Let me go across, Kunal. What's your take with regard to some of these life insurance names? HDFC Life, LIC, even the likes of an SBI Life, ICICI Pru Life. What's your view?
See, I think on the short-term charts, we're seeing a trend being evolving for many of these insurance names. So what's been happening is that the likes of ICICI Pru, HDFC Life, in the last 3-4 days, they've seen a good chunk of price volume built up for themselves. The stock prices have moved up higher by approximately 5 to 10% for the stock as an overall bunch. SBI Life has been one of the other names which has done reasonably well. The stock, I think till yesterday, was on the verge of breaking back again above its long-term moving averages. So the prospect for these stocks is quite interesting over the short term, but it's just that we wait for a breakout of the long-term moving averages for a bigger trend to evolve into these names. That confirmation is still pending from the insurance pack. So that's why we'll take it step by step. Initially, we look at a short-term rally, which means 5% to 10% kind of a category for the stock in the near term. But once we see breakout confirmations about long-term moving averages for, say, 2 out of the 3-4 names on the insurance pack, then we can attribute that the entire sector is going through a revival.
Okay. Then there's obviously SBI Mutual Fund as well. That IPO is through, and let's quickly pull out some of the subscription numbers if we can. The retail subscription, I believe, is at around 30% or 35% odd the last I had checked. There you go. You've got the retail component now at 53, so half times the full subscription. QIB, NII, employees, that's really the way in which it's shaping up. The total as of the current hour of day one is around 0.6 times. Would you go out and subscribe, Anand? What's the take here?
I mean, the business is great. SBI is one of the stronger players in the industry as well. I always had a problem with the kind of valuation some of these companies trade at in India. I mean, you look at, roughly the largest in the world, BlackRock, trades at 1/10 the valuation in terms of the assets under management versus the valuation compared to the Indian AMCs. So that kind of puts some amount of question mark on where these things can go. But broadly, it is a space which is still emerging. Growth is likely to continue, even if you think at a slightly lower space than we have seen so far. And it is something therefore that will continue to grow in terms of bottom line as well, because there is very little cost that gets added as the AMC's valuation, as the value of the AUM increases. That said, the challenge is that in India, we still have the ability to market as more important than the ability to perform. And I think somewhere along the way that will change, and people will become a little more circumspect about putting money just because somebody is pushing the particular fund to them. Net, because of the fact that it has less stickiness than, let's say, insurance, which we just discussed, I think valuations become a little more concerning. Aside from that, SBI is obviously, as I said, one very strong name. So from my personal perspective, I don't like to buy IPOs. I would wait for them to actually start trading. But that doesn't mean that one should not look at this company. It is as strong as any of the other leaders.
Right. Some of the buzzers, and I want to try and quickly focus in on Nalco, for example. How does this one look on charts, Kunal?
Yeah, Nalco is something which is very, very interesting. It's a differentiated chart altogether because it's been a lot more consistent chart over the last 3-4 years. We've seen the stock moving on from a meager amount of, I think, 30 or 40 rupees in 2020 towards 350, 360 where it's trading right now. Even the recent high for Nalco has been quite strong. It's bounced back towards its 200 moving average in this recent leg of price correction. So it looks to be a stock which is evolving quite well. I think traders with a slightly higher risk appetite, they can look to venture into the stock at the current levels. But I would suggest that keep 200 moving average as a closing base stop loss for this trade and expect the stock to show a decent bounce back.
Okay. All right. Anand, I wonder if you have a view with regard to some of the stocks or spaces where there are companies holding large cash balances, the likes of a car trade, the likes of a Just Dial. How do you look at some of these names, and any of them looking interesting to you?
So while Just Dial is trading at below cash, so therefore there is obviously some cushion in the pricing. The point is that I find the business unable to be able to grow very dramatically. At the end of the day, if you were to look at the simple metrics as how many numbers of recommendation they can have on their first page, there is only X amount of real estate that's available. Consequently, their ability to push newer categories to be able to create newer pages on which they can have new vendors to promote is somewhat limited. So, yes, pure value, great ability to grow. I think I have a few question marks there. Cart rate is a different ballgame altogether. I think they're doing exceedingly well. Business can continue to grow. There is no particular headroom problem there. Their ability to have bought over and converted a loss-making website into a profit-making one in terms of OLX has been very good. Of course, the stock has also run up accordingly. But eventually, if you are looking at a longer-term picture between the two purely on the business model, I would favor a cart trade. That's not a recommendation. I'm not taking a call on the prices of or on the valuation. I'm just saying that the business headroom seems to be higher for cart trade as of now.
Okay. And Kunal, I wonder if you have a view with regard to a Biocon, the 6.5% move sustaining. Pharma in general also doing well. Even a Divi's is up 3.5+%. 7,200, the levels have changed with regard to Divi's.
Yeah, so I think Divi's is interesting. Biocon also I think is an interesting chart because we're discussing a range of 400, 435, 440 for Biocon. Today the stock is back again towards challenging this upper end of the range. 440 is the major breakout point. But the approach of the stock today is very, very interesting. Of course, it's on the back of the news flow for Biocon at the start of the trading day. But then the volumes today on the much higher side. It'll be interesting to see the delivery data for the stock price, whether there's been a good amount of delivery buying on the stock today, or whether it's more to do with the short covering on the F&O side. But if we happen to see a blend of both short covering as well as delivery-based buying, then we could probably expect that the stock can see a further legs on the upside. The breakout point which I'm waiting out for Biocon is 440 levels to be taken out. We are very close to that kind of a zone for the stock price, but it's always better to try and wait for that confirmation when we are so close to that kind of a level. So 440 is a breakout. About those 440 levels, expect the stock to come back into at least a 485 to 490 in the very short term.
Anand, do you have a view on Pharma? And if so, how are you playing it?
Well, pharma is obviously one of the better positioned sectors, unlikely to have tariff problems in the US. The US market has stabilized and is growing. The pipeline of stock of drugs going off patent is again actually fairly large. And of course, you have a few blockbusters that are there in the pipeline generally. Domestic market continues to grow at 13%, fairly healthy clip. Net, I think for the last few years, only the domestic market was moving up, whereas the international market had pretty much remained flat or become more difficult to deal with. That headwind is now gone. So if you put in the kind of the fact that, we remain one of the best players in the market, have the best kind of product outline, the best FDA facilities, the ability to export, the fact that the rupee has fallen, all of it are in favor. How do you play it? At this stage, a mix of domestic players as well as those which are exporting to regulated market would be the best bet. Some of the leaders have already shown that in the price, but I think there may be a little more to go.
Okay. Also, the textile pack, that one's in focus. PDS is doing very well in trade, for example, today. Company has signed a multi-year agreement with a global sourcing arm for a global supermarket retailer. The agreement is to focus on expanding global sourcing and supply chain management. Ravinder here with the details.
Well, as PDS Limited is in focus in today's session after company has signed a multi-year sourcing as a service agreement with global sourcing arm of a leading French headquarters supermarket retailer, and under this agreement, PDS will manage textile and apparel sourcing across Bangladesh, India, Pakistan, Sri Lanka and Turkey, with the operation commencing from 1st of November, and the company will provide end-to-end sourcing and supply chain management services through a dedicated operating subsidiary, enabling the retailer with a more agile and scalable sourcing model. And PDS expect to manage annual appearing sourcing of over $250 million under this contract, making its meaningful addition to the sourcing platform. And this partnership will further strengthen PDS long-term relationship with the global retailers, reinforcing its sourcing as a service business model, and expands its global sourcing and supply chain management platform. And remember that in Q4 FY26, management has guided guided 40 to 50 basis point annual gross margin expansion and 50 to 70 basis point EBITDA margin expansion over the next 1 to 2 years, while maintaining the mid-single-digit revenue growth and targeting around 10% profit growth. And as of early April 2026, the company's FY27 order book stood at approximately 5,074 crore, providing healthy revenue visibility. So back of this multi-year deal, PDS Limited is in focus in today's session.
Okay, thank you so much for that, Ravinder. Anand, as a larger trend, you expect some of these textile companies exporting to US, UK and European markets to do well in the medium term, given the kind of FTAs, etc., that are coming in place?
Well, right now, I think, we are in a sweet spot in terms of the export of garments, etc., because especially cotton, two things have happened. One is that, you've had a good crop and therefore prices in raw materials have been low and most of the companies are likely to report good numbers. More importantly, because of the fact that we've had petrochemical prices going up, the competitiveness of cotton has also improved because, as the synthetics go up, the ability of the cotton prices to move up also increases. On both counts, at least those which are in the business of cotton textiles are going to do reasonably well. And exports are, I believe, quite robust at this stage. On a longer term basis, it is a cyclical industry. You have to keep that in mind. So it's difficult to take a call. But I see a good next to 10 to 12 months, at least, numbers being reasonably decent.
Okay, understood. Anand, we let you go on that note. Thank you so much for joining us, giving us that perspective. And coming in today and giving us your time. Quickly, Kunal, on to some of these textile names. Any one or two stocks which stand out for you?
See, I think Welspun Living is the only one which is looking very, very strong. Raymond is the other name which, of course, has done reasonably well on the long-term charts. But what's actually happened is that because of the steep run-up in the last 3 odd months for many of these names, it just looks like that maybe I think we are into that slight overbought territory for these stocks to try and initiate a buy. What happens is many times prices move first, news follows later, or even they follow later for the stock prices. But it's always better to try and buy these stocks at the points where the risk reward is a little attractive. Right now, the risk reward for a fresh buy is not very attractive.